Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're looking at two consumer and reopening focused stocks to consider buying ahead of earnings, and that is Disney and Airbnb, which both report later this week. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into Disney and Airbnb, it's worth quickly breaking down some of the recent economic data and what's going on with the market to help better understand what to possibly do with Disney and Airbnb. So the U.S. economy fell well short of jobs expectations for April last week. So employers added only 266,000 new jobs when projections had called for roughly 1 million. So that's a huge miss. The dramatic slowdown in hiring could be setting back an economy that looked been kicking into high gear with Q1 GDP up 6.4%. So economists and analysts provided multiple possibilities for the big miss in why businesses found it harder to hire new employees despite the seemingly strong conditions. So some of the reasons for the disappointing numbers likely stem from a combination of expanded unemployment benefits, childcare setbacks amid continuing school closures, and lingering coronavirus fears. So the new data, which accompanied a downward revision for March, will hopefully prove to be just a blip on the radar to longer-term recovery. Considering the backdrop that we have more than 40% of all U.S. adults fully vaccinated and the daily number of COVID-19 cases are on a decline. So with this, more states, including some of states with the largest cities in the country from New York to Illinois, are paving the way for a much more expansive reopening as restriction after restriction are lifted. Some of the recent economic data, besides that jobs report, helps validate the broader growth. So for instance, U.S. GDP jumped by a seasonally adjusted rate, as we mentioned, 6.4% in the first quarter to put the economy within 1% of its pre-pandemic levels. And this is according to Commerce Department data. And also the latest round of stimulus checks helped propel a 4.2% month-over-month pop in consumer spending. That was for March as well. So it's its biggest jump since last summer. And still, the U.S. GDP projections are expected to climb about 6.5%, which would be the strongest growth in roughly 30 years. So that new jobs data from Friday saw the NASDAQ climb about 0.9%, while the S&P and the Dow both hit new records as well. That came as investors decided a rise in interest rates was even less likely given that data. Then we saw the Dow and the S&P 500 barely in the green in early afternoon trading on Monday, with the NASDAQ down again about 1.3%. So people sold off after the pop on Friday after that rough jobs data from April. So with this all in mind, we're going to take a look at two companies that could certainly benefit from the broader economic reopening and as people try to return to more normal living conditions and going about their daily business and other fun things that they haven't necessarily been able to do over the last year. So we're going to look at Disney first, which trades on the ticker DIS. Its shares have soared over 70% in the past year, which easily outpaces the S&P 500's 50% climb. And this comes despite the fact that movie theaters and theme parks were closed throughout a lot of the last year, as Wall Street looked to those streaming TV growth numbers. So the entertainment conglomerate just recently reopened its California parks, and more people are starting to return to movie theaters as well. So the question now is it time to buy Disney stock ahead of its second quarter fiscal 2021 financial release that's due out on Thursday, May 13th. So the coronavirus pandemic forced Disney to close its massive theme park resorts around the world last year. Movie theaters were also closed for an extended period of time, forcing Disney to push back theatrical release dates and then change up whether or not they wanted to just release some of their offerings straight to streaming platforms. So amid these tough operating conditions, Disney's revenue dropped 42% in the third quarter of FY20. Luckily, Disney had launched its streaming TV service in November of 2019 as part of a massive push into the future of entertainment. The company also spent roughly $71 billion to buy key Fox assets. Those moves helped Disney successfully burst into the streaming TV scene alongside Netflix and Apple and Amazon and the countless others. So with this in mind, Disney's revenue fell about 22% over the last 2 quarters as its direct-to-consumer sales surged 73% in Q1 of 2021. Disney Plus in March of this year topped 100 million global subscribers after roughly just 16 months, which crushed its guidance. So with this in mind, it's actually really impressive. So Disney executives' initial goal was for about 60 to 90 million subscribers on Disney Plus by 2024. Disney now expects to reach between 230 to 260 million over this stretch. With that in mind, just for reference, Netflix closed the first quarter with about 208 million. So Disney Plus, in just over 16 months after it launched in November of 2019, reached over 100 million subscribers, blowing away its estimate. It's almost half of what Netflix is currently at the moment, but Netflix has been around for years and years and years. So Disney's direct-to-consumer offerings also, so they include Disney Plus, Hulu through the ownership now with that Fox deal, as well as ESPN Plus, which are all available in a bundle as well. The family-friendly titles, as well as big blockbuster franchises such as Marvel and Star Wars, have clearly attracted customers. The company has also poured money into original shows and movies, and it raised its price recently in March for the basic Disney Plus to $7.99, up from $6.99. So now that they've locked a lot of these people in, they're going to be making even more money off of them. So meanwhile, Disney reopened its California theme parks on April 30th at a limited capacity, which is welcome news for investors after the larger Florida parks reopened last summer. So on top of that, movie theaters are now open throughout much of the US, and some of the recent box office numbers are rather encouraging. Let's also remember that prior to the pandemic, Disney's Star Wars and Marvel movies were dominating movie theaters and box office results. So this trend could easily continue, and the company recently announced the next phase of its Marvel movie release dates, so that could see them once again dominate those box offices. Zach's estimates call for Disney's adjusted Q2 FY21 earnings to slip about 53% from the year-ago period to 28 cents per share and about 10.6% lower revenues. Peeking ahead, however, the company is projected to return to growth in a big way as streaming grows and people storm back into theaters and parks ready to spend. So Disney's full year fiscal 2021 revenue is set to pop 7% to climb right back to pre-pandemic levels at about $70 billion. So $69.6 billion would see it return right back to pre-pandemic levels. And then the company's FY 2022 sales are projected to soar 25% higher all the way up. And then if we look, Disney's full year fiscal 2021 revenue is set to pop 7% to climb right back to pre-pandemic levels at about $70 billion or $69.6 billion to be exact. The company's fiscal 2022 sales are then projected to soar 25% higher to reach $87 billion, with this growth rate easily topping 2019's 17% expansion, which included that Fox deal in the first year. So at the bottom end of the income statement, Disney's adjusted earnings are projected to climb about 1.5% this year and then 143% in 2022. Disney's longer-term consensus earning estimates have moved higher over the past 30 days, and the company has beaten our adjusted earnings per share estimates by an average of 120% in the trailing 3 periods. So after the strong run off the market's coronavirus lows, Disney has cooled down a bit. It's up just about 2% in 2021 versus the S&P 500. It's roughly 12% climb. As of Monday, it was up about 1% through early afternoon trading at around $187 per share, which still puts it about 8% below its early March records. The pullback has also pushed Disney below neutral RSI levels at one point, so below 50. It now currently sits at about 53, so just over those neutral levels, but well below those 70 overbought levels, which could easily give the stock room to run if it's able to impress on May 13th. Investors should know that Disney is also trading about 35% discount to its own year-long highs in terms of forward 12-month earnings. That is still so it's trading at about 48.6 times forward 12-month earnings, which is still a pretty big premium compared to its industry's 25 and the S&P 500's 22. But Wall Street has seen a reason to pay up for Disney, given its Fox deals and its impressive streaming growth, considering that along with all of its parks business and its theatrical business. It now has a company that's could be on par with Netflix in the long run. So that's why people have been willing to pay up for Disney. Disney currently lands a Zacks ranked number 3 hold at the moment, and investors might want to consider Disney as both a near-term reopening play and a bet on its dominance in entertainment for years, if not decades to come. As always, though, playing stocks for near-term gains around earnings is a little bit risky, especially amid all of this volatility. But long-term, Disney investors probably couldn't necessarily go wrong on if you have a year-plus horizon for this really great company within the broader entertainment space that has its eye on the future and really successful entry into that streaming TV market over just a year and a half so far. Now we're going to move on to another company that's much newer and far different than Disney, but it's also prepared to benefit from the broader reopening and consumer spending as people try to get back to their normal lives. So that is Airbnb Inc., which trades under the ticker ABNB. It is set to release its first quarter 2021 financial results after the market closes on Thursday, May 13th. So the same day as Disney. Airbnb began back in 2007 in San Francisco. Today, the rental company has expanded to over 4 million hosts who have welcomed over 800 million guests in almost every country across the globe. And the company just went public in December of 2020. And it priced its shares at about $68 a piece, which was well above its target range at the time of about $56 to $60. This showcased how much people really were clamoring for that IPOs, and they debuted near DoorDash and as well as other companies. The positivity, came despite the fact that the coronavirus had crushed much of the global travel market, and Airbnb had actually planned to make its widely anticipated public debut earlier in 2020, but then obviously the coronavirus forced setbacks. So as consumers locked down throughout much of the world early on in the coronavirus, Airbnb borrowed $20 billion to shore up its cash reserves. The company also said it would cut about 2,000 jobs, or about 1/4 of its staff at the time back in May. The company also paused investments in non-core operations and slashed other big expenses, including marketing. So they really cut back amid all of this, and then were able to go public back in December. So the stock began trading at a whopping $146 a share on the NASDAQ, which was more than double its IPO price. The company then ended the day worth just over $100 billion, which was greater than the combined market value of Marriott, Hilton, and Hyatt all together, which was wildly impressive and does showcase that maybe more people are gravitating towards these shared host spaces instead of hotels, especially amid the coronavirus, where you can be more secluded and by yourself. So obviously this showcased the short-term rental market's ability to grow and just the brand of Airbnb itself. The company said that a majority of its guests are now going directly to Airbnb when booking its short-term rentals, instead of, say, going to a site like Expedia or something like that to find out where they want to book and plan a trip. So normally the company's listings are popular throughout the world and in big cities, but the summer showcased that more than half of its bookings were made for stays within 300 miles of a guest's location, so in more secluded areas this past summer and recently. But as things slowly get back to normal, maybe you can see more and more of these people staying maybe in big cities. The question will be, especially in the near term, is what does that European and other international markets look like for Airbnb? So as of the end of September, the company had about 400 million hosts and 7 million listings of home rentals and experiences, such as guided activities, in about 220 places globally. And this is according to its prospectus for its IPO. And we should note that at the depth of the pandemic, Airbnb forecasted that its 2020 revenue would be less than half of what it was in 2019. And on a positive note, it ended the year with its 2020 revenue down only about 30%. So it brought in $3.4 billion in 2020 compared to about $4.8 billion in 2019. But to still make $3.4 billion in 2020 in the middle of a global pandemic, down only 30%, was clearly seen as a win in the eyes of many investors. And we should note that its fourth quarter results, which was its first report as a public company, its sales were down just 22%. So trending in the right direction. Obviously, it's hardly ideal amid all of this to see a big company who just went public see their first year revenue down 30%. But that was better than some of their competitors. The revenue for the same period was down an average of about 61% for Marriott and Hilton. This is according to the Wall Street Journal, and an average of about 65% for the major online travel agents such as Expedia. So Airbnb faring much better than some of its competitors, which was probably the reason for that strong debut. So now if we look ahead, we're calling for the company's first quarter revenue to come in at about $715 million, with it expected to post an adjusted loss of $1.15 per share. But if we look at the full year, so the full year of 2021, we're calling for 42% growth from the year ago period, so up to $4.8 billion, with its loss expected to be cut really impressively from a loss of $15.53 per share in the year ago period, all the way down to a loss of just $1.74. And then if we look ahead to 2022, we're calling for another 36% growth on the top line, all the way up to $6.5 billion, which would see it pull way above pre-pandemic levels, with this year, 2021, actually setting to get right back up to those pre-pandemic levels in 2019, matching about $4.8 billion. So a strong return to growth for Airbnb is expected this year, which is a positive sign for people returning back to their normal lives. And then on the bottom line, it's expected to cut its adjusted loss from $1.74 all the way to just 49 cents per share. So it's trending heavily in the right direction for Airbnb at the moment. And all of its earnings estimates have trended in the right direction since it reported its results, which is also a good sign. And in terms of broader brokerage recommendations, the company has 10 buy ratings at the moment and 16 hold ratings, and 10 strong buy ratings, 2 buy ratings, and 16 hold ratings. So a lot of brokerage recommendations are at hold or buy, with none in sell or strong sell. So positivity in terms of the brokerage recommendations that Zacks has for Airbnb. And so far, the stock since going public in December is up about 2.4%. The stock got all the way up to about $219 a share in mid-February, but it's down about 30% since then. It was down around 2% through morning trading on Monday at around $148 per share. So that's actually right near its closing price on its debut of around $145 per share. So at the moment, Airbnb is trading basically where it was right after it went public in December. And its shares are actually down 17% since the end of April. So a big downward trend recently. So if you're a long-term Airbnb believer, it certainly might not be a bad time to think about buying the stock. Obviously, the near-term volatility of the market might want to make people see what the actual long-term or near-term guidance is, especially amid uncertainty in the coronavirus front throughout much of the world. So probably want to wait if you're trying to buy Airbnb, either for the long term or the near term, to see what their actual results come in, and more importantly, what their guidance looks like in terms of if people are going to continue to return to, say, cities to have these short-term rental bookings. With that said, though, the stock is certainly oversold at the moment. Its RSI is sitting at 26, so well below that 30 threshold that's considered overbought. And the stock's trading at about 17 times forward 12-month sales, which is well below its median of 22 and well below its highs of about 28. So you're certainly getting some value for Airbnb. And the stock is currently at Zacks rank number 3 hold, which is also what Disney is heading into its earnings release on Thursday after the bell. So that does it for today's episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.